I'm sure you've heard the news. Venezuela, once a powerhouse of oil, now the center of a global showdown. But what if I told you this story isn't just about a country or its president? It's about how the United States turned Venezuelan oil into a weapon of influence, reshaping the world's balance of power. How did the US transform a single nation's oil reserves into a global power play? That's the question we're answering today. Stay with me, because the real story is bigger, more complex, and more consequential than you might think. The pre-dawn raid in Caracas was swift, dramatic, and designed for television. The city, still shrouded in darkness, was suddenly alive with the glare of emergency lights and the thunder of boots on concrete. News cameras captured every moment, broadcasting the spectacle to a world eager for answers. But beneath the surface, this was more than just a show of force. It was a carefully orchestrated message crafted for both domestic and international audiences. The choreography of the raid, the timing, and the media presence all pointed to a deeper strategy, to demonstrate not just power, but the ability to shape narratives on a global stage. When U.S. Special Forces captured Venezuelan President Nicolás Maduro in early 2026, the world saw a spectacle of military precision. The operation was executed with flawless coordination, leaving little doubt about American capabilities. Yet, while the headlines focused on the dramatic arrest, the true significance of the event was far more complex. This was not just a military victory, but a calculated move in a much larger geopolitical chess game. The U.S. had demonstrated its reach, its intelligence capabilities, and its willingness to act decisively in the Western Hemisphere, a region long considered its strategic backyard. But to focus on Maduro is to miss the point. He was never the true objective. His capture was a symbol, a signal to the world that the rules of engagement had changed. The real story was unfolding on a much larger scale, one that spanned continents and economies. In the 21st century, the fate of a single leader is often less important than the control of resources, infrastructure, and the networks that bind nations together. Maduro's removal was a headline, but the real news was the shift in the balance of power over something far more valuable than any one individual: Venezuela's oil. This operation was never truly about one leader. It was about sending a message on the map of global trade. The world's attention was drawn to Venezuela, but the implications rippled outward, touching every nation invested in the flow of energy and resources. Venezuela sits atop the world's largest proven oil reserves, a fact that has shaped its history and its fate. For decades, its oil has fueled economies from the United States to China, making it a critical node in the global energy network. By intervening so publicly, the U.S. was not just toppling a regime, it was redrawing the lines of influence that determine who gets access to the world's most vital commodity. The real target: the network of ships, pipelines, and financial systems that move oil. These are the arteries of the global economy, and whoever controls them holds immense power. The U.S. wasn't just seizing a president, it was seizing leverage over the world's energy lifeblood. Consider the vast web of tankers that crisscross the oceans, the pipelines that snake across continents, and the digital platforms where oil futures are traded in milliseconds. Each link in this chain is a potential point of influence, a lever that can be pulled to reward allies or punish rivals. By asserting control over Venezuela's oil infrastructure, the U.S. gained a new tool to shape global markets and project power far beyond its borders. The U.S. showed it can control resources not by war, but by making access risky and uncertain. By tightening the screws on infrastructure and access, they demonstrated a new kind of dominance, one that relies on uncertainty and risk rather than open conflict. This was economic warfare, waged in boardrooms and on trading floors. In the past, empires sent armies to seize resources. Today they use sanctions, regulatory hurdles, and the threat of disruption to achieve the same ends. The closure of a refinery, the denial of insurance for a tanker, or the freezing of financial assets can be as devastating as any military strike. The message was clear: the U.S. could make the cost of doing business in Venezuelan oil prohibitively high for anyone who defied its will. The capture of Maduro was just the trigger for a quieter, deeper assertion of control. Behind the scenes, analysts and strategists worked to reshape the flow of oil, reroute profits, and unsettle competitors. The real battle was being fought in silence, with data and influence as the primary weapons. In secure rooms across Washington, London, and Brussels, teams of experts pored over shipping manifests, financial transactions, and satellite imagery. Their goal: to anticipate every move, to close every loophole, and to ensure that the new order held firm. This was a contest of intelligence and strategy, where the most valuable assets were information and the ability to act on it faster than anyone else. The U.S. move was a calculated play to become the gatekeeper of Venezuela's immense oil reserves. By controlling access, they could dictate terms not just to Venezuela, but to every nation dependent on its oil. This was about shaping the future of global energy, one decision at a time. For decades, Venezuela's oil had been a lifeline for countries facing shortages or seeking to diversify their supplies. Now, every barrel that left its shores did so under the watchful eye of American regulators and strategists. The implications were profound. Energy security, once taken for granted, was now a bargaining chip in a high-stakes negotiation. The true audience was not Venezuela, but boardrooms and ministries in Beijing. China, the main customer for Venezuelan crude. For China, this was a wake-up call, a reminder that their energy security could be upended overnight by decisions made thousands of miles away. Chinese officials, long accustomed to stable flows of oil from Venezuela, suddenly found themselves scrambling to secure alternative supplies. The ripple effects were immediate. Prices spiked, contracts were renegotiated, and the search for new partners intensified. The US had sent a clear signal, not just to China, but to every nation reliant on imported energy, that the old certainties no longer applied. The message, your supply chains are fragile, and we influence them. Every halted shipment, every delayed tanker, was a warning. The world's most vital resources could be turned off like a switch. In an era defined by just-in-time logistics and global interdependence, the ability to disrupt supply chains is a form of power as potent as any weapon. The US had demonstrated that it could reach into the heart of the global economy and flip the switch, leaving rivals scrambling to adapt. The real story is how the flow of oil can be manipulated to reshape global alliances and assert dominance without firing a shot. In this new era, power is measured not just by armies, but by the ability to control the invisible lines that connect nations. The map, not the man, is what truly matters. As the dust settled in Caracas, the world's leaders were left to ponder a new reality. In the struggle for power, it is the control of networks, resources, and the flow of information that determines who shapes the future. The US had redrawn the map, not with borders, but with influence, leverage, and the ever-present threat of uncertainty. To understand how the US turned Venezuelan oil into a global power play, you first have to understand the system itself. Oil isn't just energy, it's the backbone of global logistics, finance, and industry. From the moment crude is pumped from the ground, it enters a vast, interconnected web that touches nearly every aspect of modern life. Oil powers the ships that move goods across oceans, fuels the trucks that stock our supermarkets, and underpins the plastics, chemicals, and fertilizers that feed and clothe billions. Every barrel's journey is a chain of contracts, financing, shipping, and insurance. Before oil even leaves the port, it's been bought and sold multiple times on paper, hedged, insured, and financed by banks in New York, London, and Shanghai. The physical movement of oil is mirrored by a flurry of legal agreements and financial instruments, each one a potential point of vulnerability. Disrupt one link, and shockwaves ripple through the entire system. A single broken contract, a delayed shipment, or a revoked insurance policy can send prices soaring and markets scrambling. The 1973 oil embargo, for example, showed how a political decision in one region could trigger fuel shortages and economic turmoil worldwide. This system runs on trust and predictability. Buyers trust that sellers will deliver, insurers trust that risks are manageable, and governments trust that the flow of oil will remain steady. Without this foundation, the entire structure becomes unstable, and this is where the US comes in. When a superpower injects uncertainty, it doesn't need to sink ships, just break trust. The mere threat of sanctions or military action can freeze billions of dollars in oil assets, strand tankers at sea, and force companies to abandon lucrative deals overnight. The US exploited this fragility, making Venezuelan oil a legal and financial risk. Suddenly, trading Venezuelan crude wasn't just a business decision. It was a potential violation of international law, with the threat of multi-million-dollar fines or even criminal charges. Suddenly the question isn't, is this profitable? But, will my ship be seized? Will my insurer cover me? Even companies with no direct ties to the US found themselves blacklisted as banks and insurers worldwide rushed to comply with American regulations. The mere possibility of US interference turns a routine deal into a gamble. Overnight, established trade routes became high-risk ventures and the cost of doing business with Venezuela skyrocketed. This is the system behind US involvement in Venezuelan oil, a system where power isn't just about what you produce, but about who controls the rules. As we move forward, you'll see how this strategy reshaped Venezuela's fate and sent shockwaves through the entire global oil market. For much of the 20th century, the world understood blockades as a blunt instrument of power. Warships stationed off a nation's coast, cutting off vital supplies and forcing governments to bend or break. These were dramatic, visible acts of confrontation, immortalized in history books and newsreels. But in today's world of oil politics, that old image is largely obsolete. The tools of control have evolved, becoming far more sophisticated, less visible, and infinitely more complex. The U.S. approach to Venezuelan oil is no longer about physical barriers or dramatic standoffs at sea. Instead, it's about what experts call conditional access. Rather than imposing outright bans, Washington weaves a complex web of permissions, restrictions, and ever-shifting rules. This system determines who can buy, sell, or move Venezuelan crude, and under what circumstances. The result is a form of control that is both pervasive and elusive, shaping the market from behind the scenes. Every shipment of Venezuelan oil now hinges on the unpredictable tolerance of U.S. enforcement. Companies must constantly monitor new regulations, waivers, and the shifting political winds in Washington. A deal that's legal today could become a violation tomorrow, as the rules are rewritten with little warning. This constant state of flux forces businesses to invest heavily in compliance teams, legal counsel, and risk analysis, just to keep up. The uncertainty is paralyzing. Businesses fear not just hefty fines, but the risk of being cut off from global finance, having vessels seized, or ending up on blacklists that can destroy reputations overnight. For example, in 2019, several international shipping companies found themselves suddenly sanctioned for transporting Venezuelan oil, their ships detained and their access to insurance and banking services abruptly severed. The message was clear. Even indirect involvement could bring severe consequences. A single sanction can lock a company out of the dollar-based financial system, freezing assets and halting transactions worldwide. The threat alone is often enough to make even the boldest firms think twice. In practice, this means that many companies, banks, and insurers simply refuse to touch Venezuelan oil, no matter how lucrative the deal might seem. Faced with these risks, many companies quietly step away. The market itself becomes the enforcer, as fear and caution do the work of a blockade, without a single shot fired. The result is a chilling effect that ripples through the entire supply chain, from producers and shippers to refiners and end buyers. The U.S. no longer needs to send warships to enforce its will. The mere threat of economic consequences is often enough to halt trade and isolate Venezuela's oil from global markets. In effect, the specter of sanctions has replaced the physical presence of a blockade, achieving similar results with far less risk and cost. Washington can tighten or loosen restrictions at will, granting waivers or exemptions to select players, keeping everyone guessing and off balance. For instance, in 2022, the U.S. briefly allowed certain European companies to import limited amounts of Venezuelan oil, only to revoke those permissions months later. This unpredictability gives Washington enormous leverage, as allies and rivals alike scramble to interpret the latest signals. Oil flow becomes a diplomatic lever. Access is granted as a reward, or withheld as punishment, depending on the political moment. This strategy allows the U.S. to reward allies, punish adversaries, and influence negotiations on issues far beyond oil itself, from human rights to regional security. By replacing clear, predictable rules with calculated ambiguity, the U.S. turns Venezuelan oil into a tool of global influence. This approach shapes not only markets, but also alliances and power dynamics far beyond Latin America. Countries and corporations must constantly adapt, never certain where the next line will be drawn. All of this is achieved without the costs or risks of traditional conflict. There's no need for boots on the ground or ships at sea. Just the power of uncertainty, wielded through economic and legal instruments. The U.S. can project power and achieve its objectives while avoiding the backlash and escalation that often come with military action. In the end, the market polices itself, doing Washington's work, enforcing a blockade in everything but name. This new form of economic statecraft is reshaping the global oil order, setting precedents for how resources, power, and influence are contested in the 21st century. The era of gunboat diplomacy may be over, but the age of conditional access has only just begun. Insurance is the invisible lubricant of global trade. Every container, every barrel of oil, every ship crossing the ocean relies on a web of insurance policies that quietly guarantee the flow of goods. Without this safety net, the entire system grinds to a halt. No tanker sails without it. Too much risk, too much liability. If a ship is uninsured, a single accident could bankrupt the owner, and cargo losses could devastate global companies. That's why insurance is non-negotiable for every voyage. The U.S. targeted insurance first, not ships. By focusing on the financial backbone of shipping, Washington could disrupt trade without ever sending a warship or blocking a port. The moment Washington signals risk, insurers see a conflict zone, not a routine voyage. Suddenly, what was once a standard shipping route becomes a high-stakes gamble. Premiums skyrocket or coverage vanishes. For some, the cost of insurance becomes so high that it wipes out any profit. For others, no insurer will touch them at all. Without insurance, ships can't sail, banks pull financing, contracts collapse, and ports refuse entry. Even if a ship tries to move, it faces legal and financial barriers at every turn. Trade stops quietly. No drama, just canceled deals. There are no headlines, no explosions, just a silent freeze as paperwork fails to move and ships remain docked. The US only needs to signal its intentions to a few major insurers. These companies, often based in London or New York, control the lion's share of global maritime insurance. They transmit the risk, and the global logistics network grinds to a halt. Ports, warehouses, and factories around the world feel the shockwaves almost instantly. This is 21st century economic warfare. Make ships uninsurable, and you stop trade cold. It's a strategy that doesn't require a single shot, but can bring entire economies to their knees. In the world of global trade, insurance isn't just paperwork, it's power. Venezuela was never the endgame, it was the lever. For decades, the country's vast oil wealth made it a key player in global energy markets, but its true significance emerged only as the world's geopolitical landscape shifted. With the world's largest proven oil reserves, Venezuela's heavy crude is both a blessing and a curse. Its oil is thick and difficult to refine, requiring specialized facilities, of which only a handful exist globally. This technical bottleneck means that whoever controls these refineries controls the flow of Venezuelan oil. Recognizing this, China invested billions to build and upgrade refineries capable of processing Venezuela's heavy crude. This was a strategic move, designed to secure a reliable energy source for China's rapidly growing economy. Beijing's gamble was simple: lock in supply and insulate itself from global market shocks. In exchange for massive loans, Venezuela agreed to repay China in oil shipments, effectively giving Beijing a long-term discount on energy. These oil-for-loan deals tied the two countries together, making China Venezuela's largest creditor and a lifeline for its struggling economy. But this dependency soon revealed its dark side. As Venezuela's political and economic crisis deepened, oil production plummeted, refineries sat idle, infrastructure crumbled, and the promised oil shipments to China slowed to a trickle. The United States seized this moment. By imposing sweeping sanctions and blocking Venezuelan oil exports, Washington didn't just target Caracas, it struck at the heart of China's energy strategy. The move disrupted established supply chains and sent shockwaves through global oil markets. Suddenly, China's state-of-the-art refineries, built specifically for Venezuelan crude, were left scrambling for rare substitutes. Many had to run at reduced capacity or process less efficient blends, driving up operational costs and reducing output. The ripple effects were immediate. Energy costs soared, profit margins shrank, and China's manufacturing sector, already under pressure from global competition, faced new headwinds. The country's famed manufacturing edge, built on cheap and reliable energy, was suddenly at risk. For Beijing, this was no longer just an economic issue. It became a matter of national security. The government launched urgent efforts to diversify energy sources, secure alternative suppliers, and protect critical shipping lanes. The message from Washington was clear: the US could choke a rival's energy imports at will, turning oil into a powerful geopolitical weapon. This demonstration of economic statecraft sent a warning not just to China, but to any nation reliant on vulnerable supply chains. The Venezuelan crisis stands as a proof of concept, a real-world experiment in how economic pressure can reshape alliances, disrupt industries, and shift the balance of power on the world stage. The lessons learned here are already influencing strategies from Beijing to Washington and beyond. The US action was more than just a policy decision. It was a global broadcast of power, a message sent not only to Venezuela, but to every nation, corporation, and investor watching. In the interconnected world of energy and finance, such moves ripple outward, shaping perceptions and behaviors far beyond the immediate target. It demonstrated that access to vital resources and lucrative markets is conditional, not guaranteed. The US, by leveraging its economic and legal might, reminded the world that participation in the global system comes with strings attached, strings it can pull at will. The real genius of this strategy is psychological. The mere threat of US intervention, be it sanctions, asset seizures, or legal action, can be almost as powerful as the intervention itself. Boardrooms from London to Singapore weigh not just the rules but the risks of crossing invisible American red lines. Seize one tanker, and the market self-censors. Shipping companies, insurers, and traders quickly adjust their behavior, often overcompensating to avoid even the slightest chance of US retaliation. The chilling effect is immediate and widespread. Fear is now priced into every deal. Companies avoid risk, reroute supply chains, and rethink investments. The uncertainty created by U.S. actions becomes a form of control, as businesses and governments alike second-guess their every move. Wary of triggering the next crackdown, the world is reminded, U.S. dominance is not just a relic of the past, but a living force, embedded in the very architecture of global trade. Every shipping lane, every financial transaction, every cross-border deal is touched by American influence, whether directly or through the systems it helped build. The dollar remains the world's reserve currency. Western banks are gatekeepers of global finance, and maritime law is often interpreted through an American lens. These pillars of the international system give the U.S. levers of power that extend far beyond its borders. The Venezuelan oil play was a case study in this dynamic. By targeting a single country's exports, the U.S. demonstrated it can still set the rules and decide who gets to play. Allies and rivals alike took note, recalibrating their strategies in response. In the end, power is exercised not just through force, but through the psychology of risk. The fear of exclusion, the anxiety of uncertainty, and the ever-present possibility of American intervention shape the decisions of actors across the globe. This is the true legacy of U.S. power in the 21st century, a dominance maintained as much by perception as by action. When Venezuelan oil was abruptly removed from global markets, the impact was immediate and far-reaching. The world's intricate web of energy supply was thrown into disarray, echoing the oil shocks of the 1970s, but with new complexities shaped by today's interconnected economies. Oil prices surged almost overnight, hitting consumers at the pump and rippling through every sector reliant on transportation and logistics. For families, this meant higher costs for groceries, travel, and heating. For businesses, it meant shrinking profit margins and tough decisions about passing costs on to customers. Central banks around the world suddenly faced a dilemma. Should they raise interest rates to combat inflation, risking a slowdown or even recession? Or should they keep rates low to support growth and risk letting inflation spiral out of control? The stakes were high, and every move was scrutinized by markets and governments alike. This uncertainty didn't just stay in the boardrooms, it filtered down to ordinary people. Families worried about rising mortgage rates, retirees watching their pension values swing with the markets, and investors bracing for volatility. The anxiety was global, touching households from Berlin to Buenos Aires. A new risk premium was born in energy markets. Now, a single signature in Washington could disrupt global supply chains overnight. Traders and companies had to factor in not just natural disasters or geopolitical conflicts, but also the unpredictable power of U.S. policy. The result? Markets became more volatile than ever. Every new sanction, every threat to a shipping route, every rumor of political instability sent shockwaves through prices. Traders began to worry not just about Venezuela, but about other potential choke points, like the Strait of Hormuz or the South China Sea. Even for the United States, the costs were significant. Enforcing sanctions required vast resources, legal teams, intelligence gathering, and international coordination. And as the U.S. wielded its financial power more frequently, some began to question whether the dollar's dominance was being taken for granted. Other nations took notice. Countries like China and Russia accelerated efforts to build alternative payment systems, trade in non-dollar currencies, and create alliances less vulnerable to U.S. pressure. Even traditional allies began exploring ways to insulate themselves from American sanctions. In the short term, U.S. leverage was undeniable. But in the long run, the aggressive use of sanctions risked accelerating a shift away from U.S. dominance. The more the dollar was used as a weapon, the more incentive others had to find alternatives. Around the globe, people watched these developments unfold in real time. Governments, businesses, and ordinary citizens alike began adapting to a new era, one where energy, finance, and geopolitics were more tightly intertwined than ever before. The world was not just watching, it was preparing for what comes next. In today's world, the most decisive battles are no longer fought with warships or armies, but with financial tools and economic influence. China, recognizing this shift, is preparing to challenge the United States not on the open seas, but on the financial battlefield. Here the weapons are currencies, payment systems, and the ability to shape global economic alliances. The contest for supremacy is moving from visible military might to the invisible, yet powerful, flows of money and trade that underpin the global order. If the U.S. uses its control over resources as leverage, China's response is to undermine the dollar's dominance. For decades, the U.S. dollar has been the world's reserve currency, giving Washington unparalleled influence over international finance. This status allows the U.S. to impose sanctions, control access to global markets, and dictate the terms of trade. But Beijing is determined to erode this power, deploying a range of strategies to promote the yuan and reduce reliance on the dollar. The vast majority of global trade is still conducted in dollars, and US sanctions can effectively cut off countries or companies from the world economy. This financial weapon has been used against Iran, Russia, and most recently Venezuela, crippling their economies by denying them access to the international banking system. The message is clear. Cross Washington, and you risk economic isolation. China's strategy is clear. Promote the yuan as a credible alternative to the dollar. This involves not just encouraging its use in trade, but also building trust in the stability and reliability of China's financial system. Beijing has signed currency swap agreements with dozens of countries, allowing them to trade directly in yuan and bypass the dollar entirely. At the same time, China is investing heavily in alternative payment systems that operate outside US control. The Cross-Border Interbank Payment System, or CIPS, is designed to rival SWIFT, the backbone of global financial messaging. By building these new networks, China aims to create a parallel financial infrastructure that can withstand US pressure and sanctions. China is also forging new trade relationships and offering deals in other currencies, encouraging its partners in Asia, Africa, and Latin America to bypass the dollar. For example, recent oil and commodity deals with Russia and Iran have been settled in yuan, or euros, not dollars. This is a direct challenge to the established financial order, and a signal to other nations that alternatives are possible. The Venezuelan crisis has become a powerful example for China, a rallying cry that dependence on the dollar is a strategic vulnerability. As US sanctions crippled Venezuela's economy, Beijing stepped in, offering loans, investments, and access to Chinese markets. At the same time, China encouraged Venezuela and other partners to conduct trade in yuan, highlighting the risks of relying on a single currency controlled by a geopolitical rival. By building a parallel bloc of nations willing to trade in yuan, China is slowly constructing an alternative financial order. The Belt and Road Initiative, for example, has brought dozens of countries into China's economic orbit, with many infrastructure projects financed in yuan. This network of economic relationships could, over time, reshape the global economy and reduce the dollar's centrality. This is not a campaign of sudden revolution, but of gradual, patient change. China knows it cannot topple the dollar overnight. Instead, it is working to steadily erode the dollar's dominance, year by year, decade by decade, through persistent efforts and strategic partnerships. The ultimate goal is to make the world less dependent on the dollar and more open to alternatives. This would give countries greater freedom to chart their own economic course, and reduce Washington's ability to use financial power as a tool of foreign policy. Oil producers are a key target. China is actively courting major exporters, encouraging them to accept yuan for their oil. Recent deals with Russia, Iran, and even discussions with Saudi Arabia signal a potential shift in the balance of power in global energy markets. If more oil is traded in yuan, the dollar's grip on the world's most important commodity could weaken. To support this transformation, China is building digital platforms for global transactions. The digital yuan, already being piloted in several cities, could make it easier for businesses and governments to move money internationally without ever touching the US financial system. Fintech innovation is at the heart of China's strategy to leapfrog traditional banking infrastructure and offer seamless, borderless payments. The US's aggressive use of financial power has in many ways accelerated China's ambitions. Each new round of sanctions or trade restrictions gives Beijing more reason and more support from other countries to build an alternative system. The world is watching as a new financial battlefield takes shape, one where the outcome will define not just the next decade, but the very architecture of global power for generations to come. The Venezuelan oil saga reveals the new face of great power competition. Once the world's superpowers vied for control over physical resources, oil fields, shipping lanes, and refineries. Today the contest has evolved far beyond the ground beneath our feet. The battlefield is now logistics, finance, and technology, not tanks or ships. The ability to move oil, process payments, and control data flows has become as critical as military might. Sanctions, trade restrictions, and digital surveillance are the new weapons of influence. The US has shown it can disrupt rivals without firing a shot, leveraging its dominance in global finance and technology. But this strategy has also exposed its own vulnerabilities. Cyber attacks, retaliatory sanctions, and the risk of overreach that could undermine trust in American systems. The world now sees the system isn't neutral, and nations are motivated to build alternatives. Countries once dependent on the US-led order are forging new alliances, investing in alternative payment systems, and exploring energy sources that bypass traditional choke points. China's response isn't more warships, but a more independent financial system. By developing the digital yuan and strengthening regional trade networks, China aims to insulate itself from U.S. pressure and offer an alternative to countries wary of American leverage. The contest is fought on balance sheets, not battlefields. Corporations and governments alike are recalculating risk, shifting investments, and hedging against the next round of sanctions or market shocks. As the U.S. spends more on enforcement, its debt grows. China positions itself as a stable anchor. The world's investors are watching closely, weighing the risks of relying on the dollar against the promise of new financial centers in Asia. The real conflict is over global market confidence, not oil fields. Trust in financial systems, transparency, and the rule of law now determine who leads and who follows in the global economy. The Venezuelan crisis will be remembered as the moment the fight for global leadership decisively shifted, from barrels to balance sheets. It's a story not just of oil, but of how nations adapt, innovate, and compete in a world where power is measured in algorithms, assets, and alliances. As we witness this transformation, it's clear that the choices made today will shape the world for generations. The balance of power is no longer just about who controls the oil, but who can build trust, adapt to change, and lead with innovation. The global impact of these shifts touches every nation, every market, and every one of us. So, as the world redefines what it means to be a superpower, ask yourself, how will you respond? Will you challenge old assumptions, seek out new opportunities, and demand greater transparency from those in power? The future is being written now, by governments, corporations,